Have you ever felt like your investments just aren't paying off the way they should? So this video will break down the top 10 investing mistakes that keep you poor, but before we jump in, don't forget to hit the like button and subscribe to our channel to watch more videos like this. Let's start from number 10, not spreading out your investments. You probably heard the phrase, don't put all your eggs in one basket, and it couldn't be more true for investing. Putting all your money into one stock or asset might seem smart, it's doing well, but what if it suddenly drops? The market can be unpredictable, and relying on just one investment is risky. If it goes south, you could lose a lot of money. To avoid this, spread your investments across different options like stocks, bonds, real estate, or mutual funds. This way, if one investment struggles, others can help balance the loss and keep your portfolio steady. Diversification doesn't eliminate risk entirely, but it reduces it significantly, giving you a more stable foundation for your wealth. Number 9. Letting your emotions take control. Ever made a quick investment decision out of fear or excitement? When the market moves up and down, it's easy to panic or get overly confident. The problem is, emotional investing can lead to bad decisions like selling too quickly during a dip or chasing a trend without research. For example, when markets crash, many people panic sell at a loss. On the flip side, when stocks are soaring, some jump in without understanding the risks. The key is to stay calm, stick to a plan, and think long-term instead of reacting to short-term changes. It's not about ignoring the market, it's about staying disciplined even when emotions run high. Number 8. Ignoring how money grows over time. Did you know your money can grow by itself over time? It's called compound interest, and it's one of the best ways to build wealth. Think of it like a snowball rolling downhill. What starts small keeps growing bigger and bigger. When you invest, your earnings generate more earnings, creating a cycle that builds your wealth over time. But many people miss out on this because they start investing too late or don't reinvest their returns. The earlier you start and the longer you let your money grow, the more you can benefit from compounding. Every dollar you invest today could be worth much more in the future. Number 7. Jumping on popular trends and hot tips. Have you ever felt tempted by a hot tip or the latest buzz in investing? It's easy to get swept up in excitement when everyone seems to be talking about a trending stock or cryptocurrency. But diving into investments without fully understanding them can be a costly mistake that keeps your wealth from growing. In 2025, markets are full of flashy trends that can rise and fall overnight. Many people rush to invest in something just because it's making headlines only to watch the value drop shortly after. Chasing trends without proper research is like gambling. You're relying on luck instead of strategy. Rather than jumping on the bandwagon, take time to research and think about whether the trend fits your financial goals. Look beyond the hype and focus on investments that align with your values and long-term objectives. A thoughtful, well-informed decision always beats impulsive moves. Number 6. Overlooking hidden costs and fees. Have you ever checked how much you're losing to investment fees? Many people don't realize how much fees like management charges or trading commissions can eat into their profits over time. These small expenses may seem harmless at first, but they add up and can quietly drain a significant portion of your returns. In 2025, low-cost ETFs and commission-free trading platforms are more accessible than ever, so there's no reason to ignore fees. For example, a fee of just 1% might not sound like much, but over decades, it could cost you thousands of dollars. Being careless about fees means giving away money that could have been growing your account. To avoid this, always read the fine print. Choose investments with low fees like index funds and stay mindful of the charges you're paying. Cutting down on unnecessary costs allows your money to grow faster and keeps more of your hard-earned profits in your pocket. Number 5. Trying to predict market movements. Do you think you can perfectly time when to buy or sell investments? Many people believe they can predict the market, buying at the lowest point and selling at the peak. But trying to outguess the market is one of the biggest traps investors fall into. The reality is that even experts and seasoned investors struggle to predict market movements. Most of the time, attempts to time the market lead to missed opportunities or losses from selling too early. Instead of making gains, you might find yourself stuck in a cycle of stress and poor decisions. A better approach is to focus on long-term investing. By staying consistent and riding out market ups and downs, you can take advantage of overall growth over time. The key is patience. Investing isn't a sprint, it's a marathon. Number 4. Investing without a solid plan. Do you know what your financial goals are or why you're investing? Many people make the mistake of investing aimlessly without a clear plan. Without a roadmap, decisions are often based on emotions or short-term trends instead of thoughtful strategies. In 2025, successful investors know the value of having a concrete plan. Whether your goal is saving for retirement, buying a house, or building a safety net, your investments should reflect those objectives. Without clear goals, it's easy to get distracted by market noise and lose sight of what truly matters. Start by creating a plan tailored to your needs, considering your risk tolerance and time horizon. Write it down and stick to it. A clear investment strategy will help you stay focused and make smarter choices as you work toward your financial dreams. Number 3, relying too much on your employer's retirement plan. Do you believe your 401k is enough to secure your retirement? Many people assume their employer's retirement plan will fully support them in their golden years, but this is often a risky assumption. These plans might not provide the financial freedom you dream of, especially if you're not saving enough or the investment options lack diversity. By 2025, more individuals are realizing that a 401k alone may not be sufficient for a comfortable retirement. To avoid falling short, consider supplementing it with other investments like an IRA, a taxable brokerage account, or real estate. Relying only on your employer's plan can limit your financial growth and leave you unprepared for unexpected expenses in the future. Taking proactive steps now can help ensure a more secure retirement. Number 2, underestimating the effects of inflation. Have you thought about how inflation quietly reduces the value of your savings? Over time, inflation eats away at your purchasing power, making your money worth less. If your investments aren't growing fast enough to outpace inflation, you're losing wealth without even noticing it. In 2025, inflation continues to be a significant factor affecting global economies. Relying on low-yield investments like savings accounts or bonds might leave your wealth stagnant while prices for goods and services rise. This can make it harder to achieve your financial goals, especially over the long term. To safeguard your money, consider investing in assets known to outperform inflation, such as stocks, real estate, or inflation-protected securities. Regularly reviewing your portfolio and adjusting your strategy can help you stay ahead of inflation and maintain your financial health. Number 1, delaying the start of your investment journey. Have you been putting off investing because you think it's too late or too complicated? The single biggest mistake you can make is waiting to begin. Time is the most critical factor in building wealth, and starting early gives your money more time to grow. In 2025, many people are still waiting for the perfect moment to start investing. But here's the truth: that moment may never come. The longer you delay, the more opportunities you miss to build your wealth. Even small, consistent investments can grow substantially over time, thanks to the magic of compound interest. The best time to start is now. Even if you begin with a modest amount, what matters is taking the first step. Over time, your efforts will add up, and you'll thank yourself for starting early. Don't let procrastination hold you back. Time is the most valuable resource you have, so use it to secure your financial future. Which of these mistakes do you see yourself making? Share your thoughts in the comments. If you found these tips helpful, don't forget to like, share, and subscribe to our channel for more advice on achieving your financial dreams.